But again, as we watch the concern in the markets, as we just touched on the lows of this session, we're bouncing off of those, so that's a little good news. Gary, there is fear that at some point these interest rates move up faster than we can deal with it, right? And I want to get back to your concerns about the debt, because you're talking about $21.6 trillion that the United States economy owes. And if interest rates start to escalate, well, then what do you know? That interest on the debt becomes a whole lot more expensive. It's like you got a credit card and you had the teaser rate, and then you ran up all this debt, and all of a sudden now you're stuck with the big, you know.
And by the way, that number is only federal, that's only federal debt. And here's a number to chew on. In the fiscal year 2018, the first $550 billion of our precious tax dollars went to interest on all the debt these people created in Washington, D.C. Imagine $550 billion not going to roads or bridges or the elderly or children, to nothing, to interest. And that is a worry. And if that keeps rising, eventually that number is going to be $1 trillion that does not go into the economy, but gets taken out of the economy. So again, I think these politicians in Washington have been taunting the future of this country with this continued move. And I must tell you, I remember, I think Neil had the head of the OMB on a couple of months ago, when Neil brought up the debt and deficits, and the guy from the Office of Management and Budget basically shrugged off the question. And if you get the guy who runs the Office of Management and Budget shrugging it off, we're in pretty big trouble longer term.
Look, I was gone the last couple of days. I was in Washington, D.C., and I was there talking to a lot of economists, a lot of market experts about the challenges and getting their view on this for Social Security as we move forward, retirement for Americans as we move forward. And one of my big questions for them was, what do we do about this record debt level? And
what'd they say?
They said that, unfortunately, and I think this is very true, Washington operates on crisis. And so until it reaches the level, Gary and Adam, of being a full-blown crisis, you're not going to see much coming together there in D.C. And, we're not at that level yet, but I'm frightened about it too, Gary, because, look, great civilizations, they don't fall because of war. They fall because of debt. And I point to Rome when I say that. This is a big issue. Nobody's paying enough attention to it. At some point, we're going to have to.
Trish, the amazing part about all this debt, it's happening during a great expansion. We should have a deceleration of debt and deficits when you have a great expansion and revenues are coming into the Treasury. By the way, revenues are going to be a record high this year coming into the Treasury. Unfortunately, spending is going to be even more of a record high, and that's what's doing the trick.
That's no good. We got it. The shame of it is that's what, by the way, Donald Trump campaigned on, right, Gary? I mean, he wants to get rid of the swamp. He wants to get rid of all the needless spending. I'm bringing Tim Anderson, the managing director of MND Partners, into the conversation. He's down on the floor of the NYSE. We're talking about the debt issue and how much that's factoring into things. Tim, what do you think? Is that part of the problem here?
It certainly could be part of the problem long term, but I really don't think that's why the market is down today. I think investors are still concerned about higher interest rates. We've taken another leg down maybe in the last hour as the results came in from the 3-year and the 10-year, just a tad on the sloppy side. We're going to have the 30-year bond issued tomorrow. And I think that once we get past tomorrow, then you'll have a little bit of a relief rally in the bond market. And I think that the selling in the stock market will abate a little bit into the end of the week. We get into next week, we'll start to see earnings hopefully come out as positive as what people are talking about. And as you well know,
and then people start to feel a little bit
change
better.
very quickly.
Oh, sure it can. Hey, this is really interesting. We're looking at the 30-year yield right now. It's going to cost you 3.41% to borrow for 30 years, but it only costs 3 1/4 or so to borrow for 10 years. Walk me through that logic.
Well, there's no doubt that people have talked about the flattening of the yield curve. You could look at the 2-year also, and it's probably 2.9 or maybe a little bit higher. And I think that the slightly more significant part of the yield curve to look at is the Fed funds rate to the 2-year, and there's still at least a 50 basis point slope to that. And I think that overrules the concern about the flatness of the curve from 2 years out to 30.
You know what's interesting, Trish? The banks are actually up today. And I know that because they're the only green stocks in my portfolio. Everything that I own today is getting crushed, with the exception of the banks. And if you really thought that the economy were going to implode, you'd be selling banks today. You wouldn't be buying
But maybe you
them.
think interest rates are going up, and that's why you're buying banks, because banks benefit.
And they're,
from the
by the
higher
way, they're
interest rate
going up for
environment.
the right reason. The Fed, number one, is getting us back to normal. And number two, the economy is growing. The Fed isn't raising rates to squelch the economy. It's to keep up with the economy, to keep inflation in check. And again, the fact that banks are up today, that gives
Actually, not necessarily. Which banks are you watching? Because we're looking at, is Goldman doing a little bit better? No, Goldman's down too, 2%.
Well, my Bank of the Ozarks is up. But you know, that's my favorite regional bank, PacWest Financial, the
It's just
KRE,
kind of funny,
the
because you're going
KRE,
way out there on
which
the
is the
spectrum, all the way to the
ETF.
Ozarks.
Yep, but the
And keep in
KRE.
mind that the banks will lead us off with earnings season on Friday.
Yeah, good point.